Okay, so you want to own a country club. Picture the valet line on a Saturday morning, a kid in a white polo jogging your keys to a board behind the pro shop, the smell of fresh-cut Bermuda grass off 18 holes nobody outside the gate may walk. Picture the bar after 4, ice cracking into cut crystal, your name eventually on a small brass plaque by the 18th green, paid for, permanent, yours. Now picture last Tuesday. The irrigation head on hole 11 has leaked for 6 weeks. The part is on back order. 41 members still haven't hit this quarter's food and beverage minimum, owed whether used or not. Here is the number that should stop you. Initiation fees, the one-time lump sum required to join, run as high as $650,000 at clubs like Apogee in Florida. According to Club Benchmarking's survey, 75% of private clubs lose money on food and beverage every year. Somebody is paying that 6-figure entry fee. Somebody else is losing money serving them dinner. The governing question is simple. If the golf course is structurally built to lose money, who is getting rich here? And the answer has almost nothing to do with the golf course itself, which we'll get to later, because that's where a huge amount of the real money hides. A country club is not one business. It is 3, wearing the same blazer. The first door is the equity club, the classic version, owned collectively by its own members, who buy a literal share of the physical asset along with their membership and elect a volunteer board to run it. Because equity clubs almost always operate under Section 501(c)(7 of the Federal Tax Code, the IRS grants them exemption from income tax on member-generated revenue, on one condition: no more than 35% of gross receipts can come from non-members, and within that, no more than 15% can come specifically from non-members using the facilities. That single rule is why equity clubs are structurally engineered to hover near break-even. Profit was never supposed to be the point. The second door is the non-equity club, owned outright by a management company, where the member is not an owner at all, but a subscriber paying for access. This is the Club Corp model, now operating under the name Invited, which alone owns 125 clubs and, according to Forbes, is in the process of merging into a combined 172-course platform, valued at $2.6 billion, part of a broader wave of roll-up consolidation, private equity quietly buying up independent clubs and folding them under one operating company. The third door is quieter, and it is the one that matters here. It is the club built by a real estate developer specifically to sell the land around it, where the golf course is not really the product, and it tends to collect its entrance money in a strange way. Not quite a fee, not quite a purchase, a structure worth holding on to until the real ledger comes into full view. Same blazer, same brass plaque by the 18th green. 3 entirely different reasons somebody built the place. A parking lot full of Range Rovers is not the same thing as a profitable business. Assume, for a moment, that you are building one from raw dirt rather than buying your way into an existing membership. Here is the price of admission, and it comes in a strict order. First, the land itself. A regulation 18-hole layout needs somewhere between 120 and 200 acres, and depending on the region, that land runs somewhere between $1,000 to $20,000 an acre before a single blade of grass is disturbed. Second, shaping the golf course. Moving earth, cutting fairways, building greens to USGA specification, and installing an irrigation system across the whole property costs somewhere between $1 million and $3 million, and that is before anyone has designed a single hole. Third, the architect. A recognizable golf course designer, the kind whose name goes on the scorecard to help justify the initiation fee later. Charges somewhere between $50,000 and $500,000 just for the routing and design work. Fourth, the clubhouse, which is really a small hotel wearing a country club's name. Depending on whether it is a modest single-story building or the kind of stone and timber lodge that photographs well for a real estate brochure, that runs somewhere between $300,000 and $1.5 million. Fifth, and this is the part almost nobody budgets correctly, licensing. A liquor license alone, depending on the state, runs anywhere from $100 in Idaho to $13,800 in California, on top of health permits for the kitchen, occupancy permits for the clubhouse, and whatever local zoning process stands between raw acreage and a functioning private club. Added up, in the most conservative scenario, and it lands somewhere north of $2 million before a single membership has been sold. Now flip to the other side of the counter, the side actually being pictured at the very start. Buying in, not building, the national median initiation fee at a private club rose from $29,000 in 2019 to $50,000 in 2022, according to the National Golf Foundation, a jump of 72% in 3 years. At the top end, at clubs like Silverleaf outside Phoenix, that number is $400,000. At Apogee in Florida, it is $650,000. Read that again, $650,000, before a single round of golf has been played, before a single dinner has been eaten in the dining room. Here's the trap. None of the numbers above are the real cost of ownership. They are just the cover charge. The golf course itself is the asset that eats. According to the Golf Course Superintendents Association of America's 2024 Maintenance Budget Survey, the average private club spends $1,083,647 a year just maintaining 18 holes, and $630,104 of that, more than half, is labor, because grass does not maintain itself and greenskeeping crews do not work for free. Water alone runs close to $107,000 a year nationally. And in the Southwest, where courses are essentially green oases carved into desert, that climbs to somewhere between $200,000 and $240,000 a year. The course does not care whether anyone is playing it. It needs that money on rainy Tuesdays and empty Wednesdays exactly as much as it needs it on a packed Saturday. Then there is food and beverage, the department that loses money on purpose. Remember that club benchmarking figure from the opening? 75% of clubs lose money running their restaurants and bars. Food and beverage typically accounts for close to 30% of a club's total revenue and contributes almost nothing, close to 0%, of its actual gross profit. To keep members eating there anyway, most clubs impose that food and beverage minimum, somewhere between $100 and $200 a quarter, billed to the member whether they showed up or not. It is less a dining option than a tax with a wine list. And here's where it gets interesting. Beyond dues and minimums, clubs also reserve the right to levy an assessment, an additional charge on top of everything already paid, usually announced right after a roof fails or an irrigation system needs replacing years ahead of schedule. There is no real cap on how many times a club can go back to its own members and ask for more. The clubhouse air conditioning does not know the budget. The fleet of mowers does not stop breaking just because this was supposed to be a good year. Occupancy is not the same thing as income, and neither, it turns out, is membership. So where does the money actually come in? Layer by layer, starting with the obvious. The first layer is the initiation fee itself, the lump sum discussed a moment ago, somewhere between $29,000 and $650,000 depending on the property, paid once, upfront, before a member ever picks up a club. The second layer is annual dues, the recurring membership fee that funds day-to-day operations, typically running into 5 figures a year at a serious private club, arriving whether the maintenance budget discussed a moment ago was $1,083,647 or considerably more. The third layer is that food and beverage minimum, functioning less like restaurant revenue and more like guaranteed cash flow the club can count on regardless of actual demand, a quiet tax dressed up as a dinner reservation. The fourth layer is guest fees and outside event revenue, weddings, corporate outings, the wedding photographer who shows up on a Saturday the members didn't book, plus whatever a club can quietly collect from non-members renting the ballroom on an otherwise empty Tuesday. Remember the 35% and 15% thresholds from a moment ago? That ceiling exists precisely because this layer is tempting, and a club that leans on it too hard risks its entire tax-exempt status. Cross that line badly enough, and the excess gets hit with UBIT, the unrelated business income tax, taxed the same way an ordinary for-profit business would be. The fifth layer, and this is the one worth pausing on, is the refundable membership deposit, a structure increasingly common at newer clubs, where part or all of the initiation fee is collected not as a fee at all but as a deposit the club is legally obligated to repay, eventually, once the member resigns. In practice, that repayment happens on what the industry calls a resignation queue. Roughly 1 resignation gets paid out for every 4 or 5 new memberships sold, and refund schedules commonly stretch out 30 years. The club holds that capital, interest-free, the entire time. Capital a straightforward initiation fee would never have generated in the first place. Stack all 5 layers together, and a country club starts to look like a machine that prints money on a schedule. Members joining every year, dues arriving like clockwork, deposits accumulating quietly on the balance sheet. So far, a country club sounds like a machine that prints money. Now, here's the other side of the ledger. Here's the part nobody tells you. The golf course was never the business. It was the bait. The first layer of the real answer sits inside that refundable deposit structure from a moment ago. By collecting entrance money as a repayable deposit instead of a straightforward initiation fee, an owner avoids recognizing that cash as taxable income the moment it lands in the account. It functions in effect as an interest-free loan from the membership to the ownership, one that does not have to be repaid in full for decades, and one that can be used, in the meantime, to fund almost anything, including the next phase of construction. The second, deeper layer is who actually owns the dirt. Remember the third door from earlier, the real estate developers club, the one collecting entrance money in that strange, not quite a fee way? Companies like Discovery Land Company have built an entire model around this. 30 private, members-only communities, where the club and its golf course exist primarily to make the homes around them sellable at $3 million to $50 million each. This is what the industry calls amenity-driven real estate, building a private club mainly as the hook that sells the land around it. Living near a golf course adds somewhere between 5 and 8% to a home's value on average, and a direct view of the fairway can add somewhere between 5 and 12% on top of that. The club loses money on food and beverage. The club barely breaks even on dues. None of that matters to whoever also owns the 400 acres of home sites surrounding the 18th fairway, because that person was never really in the golf business. That person is in the business of using a golf course as a very expensive, very effective piece of landscaping. And the third layer, the deepest one, is who gets to hold the paper. When a club is structured as a non-profit under Section 501(c)(7, profit is capped by design, but management fees are not. An owner can still charge the club a management fee, still control the pace of resignations paid out of that 30-year queue, still decide when and whether to develop the next parcel of land. The initiation fee was never really a fee. It was a loan, disguised, secured against dirt that kept appreciating the entire time it was being repaid. Cordillera Golf Club, high in Colorado's Vail Valley, shows exactly what happens when that machine breaks down in public. The club was built as a genuine luxury proposition. 4 separate golf courses across a single mountainside development, meant to anchor one of the most exclusive residential communities in the state. In June of 2009, David Wilhelm and the Wilhelm Family Partnership bought Cordillera from its previous owner, Felix Posen. At its peak, not long before that sale, the club counted roughly 650 members, each paying annual dues of $12,500. In 2011 alone, the club collected $8 million in membership dues. So what actually killed it? Members later alleged in a class action lawsuit that Wilhelm kept only one of the 4 promised golf courses open, roughly 25% of what members had signed up for, while still charging them full dues on all of it. The lawsuit demanded a refund of 2011 dues plus the return of every outstanding membership deposit, a combined claim reaching approximately $100,000. Wilhelm countersued the members for $96 million. Alleging they were trying to force him out and seize control of the club themselves. By the time the dispute reached its breaking point, membership had collapsed from that peak of 650 down to just 223. On June 26, 2012, exactly 3 years to the day after buying the club, Cordillera Golf Club, LLC filed for Chapter 11 bankruptcy protection in federal court in Delaware, listing $19.14 million owed to Alpine Bank across 2 separate loans. Court filings reviewed by the Vail Daily also showed that the Wilhelm Family Partnership had paid itself close to $1 million in management fees during the very period members say they were being shortchanged. The afterlife was quieter than the collapse. New ownership, a slow rebuild, membership numbers that never fully recovered to what they were at the peak. Cordillera was collecting $12,500 a year per member for access to a fraction of what those members were promised. 4 golf courses were sold. One was open. That gap, 25% delivered against 100% build, is not an accounting error. It is the entire failure case in a single fraction. Here is the true answer to the governing question posed at the very start: why the golf course itself is built to stay near break-even while everyone around it gets richer. It has almost nothing to do with golf. Section 501(c)(7 caps how much profit a club as entity can post, because it was written to reward member service, not shareholder return. But nothing in that code caps the value of the surrounding land, and nothing caps what a management company can charge the nonprofit it happens to control. That is the loophole the entire model runs through. Build a golf course that by design cannot get rich. Surround it with 300, 400, 500 home lots that get rich instead, appreciating somewhere between 5 and 8% just for sitting near the fairway, and considerably more for the ones with the view. Then collect a management fee off the club itself, the way the Wilhelm Family Partnership did at Cordillera, nearly $1 million during the very stretch members say they were being cheated. Scale that up, and it explains the wave of consolidation now moving through the industry. KSL Capital Partners agreeing to buy Invited, the 125 club operator formerly known as Club Corp, for $2.6 billion, combining it with another 47 courses into a single 172-course platform. Nobody pays $2.6 billion for a business that survives on food and beverage revenue that loses money 3/4 of the time. They are paying for land, for scale, for the management fees a company that size can extract from every clubhouse it controls. The golf course is not the business. The dirt underneath it is the business. Picture a mid-sized private club, 400 members, dues set at $15,000 a year, sitting on a golf course that costs just over $1.8 million a year to maintain. Rough year. 25 members resign, and remember the resignation queue from earlier. The club only manages to backfill 15 of those spots with new members, each paying an initiation fee somewhere around $50,000. Food and beverage runs its usual loss, somewhere between $150,000 and $200,000 for the year, in line with that 75% industry pattern. The irrigation system needs an emergency repair nobody budgeted for, so the board issues an assessment of $2,000 per remaining member just to keep the maintenance account solvent. Added up, dues revenue lands around $5.6 million. New initiation fees bring in $750,000. The food and beverage loss and the irrigation emergency eat roughly $500,000 combined, and the club limps to a thin surplus, maybe $150,000, after a year that felt, to every board member, like an emergency. Great year. The wait list actually has people on it. All 25 resignations backfill immediately, at the higher end of that fee range, closer to $80,000 each. Guest and event revenue, kept carefully under that 15% non-member ceiling, adds another $400,000. No emergency assessment. The same $1.8 million maintenance budget, the same food and beverage losses, but this time absorbed comfortably inside a healthier dues base. Total surplus for the year, somewhere north of $700,000. Same clubhouse, same 18 holes, same 501(c)(7 filing. The difference between the rough year and the great year is over $500,000, and almost none of it came from anyone playing better golf. Picture that valet line again, engine still ticking, a kid in a white polo jogging the keys to a board behind the pro shop. It is still a real feeling. It is still worth wanting. But the 18 holes in front of you were never really the product. They were the landscaping bill that made the acres around them worth $3 million to $50 million a lot. The interest-free loan disguised as a deposit, the management fee collected quietly while members argued about which golf course was actually open. The club was never really selling membership. It was selling proximity to land that was appreciating the entire time dues were being paid to protect it.